Hi everyone, great to have you all with us. I'm your host, Nugwa Haruna. Have you ever heard of analysis paralysis? It's the inability to decide on a course of action due to overthinking, or perhaps the fear of making the wrong choice. And it often occurs when there's an overwhelming amount of data to consider. And it's a situation that investors may find themselves in when trying to choose one dividend stock over another. After all, there are many stocks that pay a dividend, and they might be plenty that fit an investor's portfolio at first blush. A novice investor might run a screen, see hundreds of potential matches, and then freeze up, not sure what to do next. A way to break through that mental block would be to develop criteria that would help narrow down the list of possibilities. And we're going to hear one approach in our conversation today. Joining us is Mike Héroux, founder of Dividend Stocks Rock. He's a long-time dividend growth investor who developed screening criteria he dubs the dividend triangle to get started in his research. Mike shared the details of the dividend triangle in a previous webinar with us, so check it out if you haven't had the chance to do so already. And now he's going to fill us in on the rest of the decision-making process he uses to whittle down a long list of potential candidates to just a handful of top choices. Mike, it's great to have you back with us. Thank you for taking the time.
Thank you, Nugwa. It's great to be back. I mean, second time and kind of like a continuity because, I mean, it's a good thing to know what you're looking for. But unfortunately, when you pull out those screeners, you're going to end up with like dozens of great choices. And money, time, and resources are limited. So it's better off to narrow it down to make simple choices.
Right. Okay. So you referred to our previous webinar that we had done earlier in the year. So for those in the audience who didn't have a chance to catch up on that earlier webinar that we did, can you share a little bit of your backstory and what led you to launch the Dividend Stocks Rock community?
Yeah, actually, I work in the financial industry as a financial planner and private banker for about 13 years. And at one point, I just decided to take a pause, travel the world with my family. And at the same time, I had this like small gig developing, which was Dividend Stocks Rock. And I realized that most investors lack of confidence because they have like too much information and they don't know which one is good. So to make good decision, it's good to have like a straightforward process, something with a little bit more clarity. And by following few steps, you're going to be a lot better and you're going to feel a lot more confident in your selection just because you narrow it down in like A, B, or yes, no answers. That makes it all the difference.
Okay, so before we hop into our conversation, you mentioned, you like to travel, and I know you just returned from a trip to Tanzania where you actually climbed to the top of Mount Kilimanjaro. What was the view like from up there?
Oh, that was crazy. But it's kind of funny because, you spent 40 minutes on the top. Like usually it's maximum 30 minutes, but we have like one of our member that needed oxygen. So just to show you how sometimes it could be difficult to deal with altitude. And the most amazing part actually is the 18 months before. So the training, the preparation, the time spent on the mountain, because you spent like 5 to 7 days to climb up, to acclimate. And then you talk with your guides, you discover the beauties of those landscape and the nature. You make new friends. And then once you got to the top, it's pretty much the final point of your destination. But in the end, it's not the final point that's really important, it's really the journey, and actually could relate a lot about investing. The point is not to get to retirement. It's this long journey of how you manage a portfolio, how you manage stress, and then you're going to hit some headwinds as we hit in the mountain. Some days are like worse than others, and you need to have a good plan to move ahead. And on the final day, you wake up around 10 p.m. and you start the ascension at midnight. And I asked my guide, well, why do we start in the middle of the night when we don't see anything and we have like 12 hours of hiking? I mean, we could do that during daytime most of the time. And then he told me, he's like, when you walk and you don't see past your front light, you just go one step ahead and you don't think about anything. You don't think about being tired. You don't think about having another 2 kilometers to do or like 3 hours of hiking. You just say, okay, one step forward and everybody can make one more step. So when you're in my middle of a financial crisis, pretty much similar, you're not too sure what's happening, but you can just pass the day, pass the week, stick to your process, follow the plan, trust your guide, and then you're going to go through that crisis without any problem.
I love how you tied that back to investing, right? Where the idea is, instead of saying, I sleep, wake up, my account is not at a million yet, so this is not the strategy for me. It's more about pacing yourself. So, right. So let's hop right into the conversation. So great way to tie that in, your everyday life to investing in itself. Now, when it comes to dividend, companies that pay dividend, as we talked about, when investors screen for them, they may end up with a really long list of companies. So some investors may be tempted to take positions in many of these companies that pop up. So why do you feel this might be counterproductive?
Well, the thing is, whenever you pull out a screener and whatever your metrics, it doesn't have to be the dividend triangle, but whatever metrics you want in your screener, you're going to make a list of companies that are doing great right now because you're looking at the past 3 years or the past 5 years, but it's pretty much the same thing. So what really happened is you're going to have specific sectors that are doing incredibly well at the moment. For example, if you look at the past 2 years, energy sector has been in high demand. They all show growing cash flows, growing your earnings, growing revenue, and so on. So they're all positive. But then if you end up buying a dozen of energy stock, what happens if at one point the oil barrel crash and we saw that in the past? So what's gonna happen to your portfolio? Well, unfortunately, your entire portfolio will be at risk because you have selected similar companies in the same sector doing well, but most of them, they do well just because the sector is doing well. So when there's a high demand for a specific product or for a specific industry, they all look good on prom night, basically. But then you want to see which company will look good the next morning after the party ends.
Now, let's look at the 6-step process that you have and you use when you're looking at a long list of dividend stocks to identify companies that will stand out in each sector. And so we did touch on, a little bit on, the dividend triangle. And so we'll be comparing 2 examples using your criteria. So you mentioned the first step would be screening, looking for, using the dividend triangle. And let's go a little more into detail into those 3 matrix that make up the corners of your triangle. And why do you feel they offer a valuable insight?
Well, at first, it will give you a good idea of what really happened in the past 5 years. And right now that we consider that the pandemic hit like in 2020, so we will have companies that will have a hard time for maybe 1 year or 2. But overall, over the past 5 years, we want to make sure that the revenue is positive. Before the pandemic, I was asking a little bit more in my screener, maybe like a minimum of 5% growth rate or something like that, because I want a company that is thriving, especially when you are in a good financial position, when the economy is booming, interest rates are low. You want a company that is able to generate growth during those times, because whenever there's a recession or now we're like having high inflation, interest rates are increasing, we're kind of worried about what's going to happen in the economy. Well, the growing companies will be able to go through that recession without any problem because they're already on their way. After that, earnings, super important. Same thing. I really prefer to look at the trend because 1 year of great earnings doesn't tell you much. Same thing as if the earnings go down. So I'd rather look at the trend and see, is it like year after year going slightly higher up? And if so, well, then I have a good business with a solid business model that will eventually increase their dividend. When you look at the dividend growth rate, ideally over 4 or 5% per year. So that would be the ideal scenario. Obviously, if you're looking for companies like REITs, for example, that are slightly more stable, they will not grow that fast. Maybe like a 2-3% increase will be enough. But you want to see some growth there, because if it doesn't grow in the perfect environment, as we now are shifting the economy towards something a little bit more challenging, how can this company can increase its dividend in the future? And most of the time, if you don't see any dividend growth during great economy years, well, unfortunately, you're going to have dividend cuts while they hit some speed bumps, and then the recession goes in and they have some bad news, and they will eventually say, oh, we're cutting down our dividend, but it's because we want to gain financial flexibility. In the end, for investors, that means loss of income. and loss of capital.
All right. Okay. So let's take a moment to jump into WebBroker to show our audience how they can screen for the dividend triangle criteria.
Click Research. Under Tools, click Screeners. The Screeners tool allows you filter for stocks using specific criteria. Once here, click on Screening and clear All. Next, click on More Criteria to create your dividend triangle. We'll start off by adding earnings per share growth last quarter versus prior year, and we'll set our minimum earnings per share growth last quarter versus prior year to 0. Next, we'll go More Criteria, and we'll add earnings per share growth 5-year historical. Once again, we'll set our minimum to 0. We'll go More Criteria, and this time we'll add revenue growth last quarter to prior year and set our minimum to 0. Now moving on to dividends, we'll go More Criteria, and under dividends, we'll add our dividend growth rate current year to prior year and set our minimum to 0. Finally, we'll add our dividend growth rate 5-year average and set our minimum to 0. In order to narrow down our matches even more, we can select stocks that trade on the Canadian exchange alone. And this brings our matches to 53 companies. And then we can scroll through and do some more research.
Okay. Hopefully that demo helped our viewers understand one way to get their research into dividend stocks started. And if you want to learn more about Mike's approach to using the dividend triangle, make sure to watch our webinar, Why I Use the Dividend Triangle to Build My Portfolio, available in the Learning Center. All right, Mike, let's go on to the second step in your process, which is to narrow down the list of companies with a simple business model. Why do you feel that's important?
It's really important because when you buy a stock and it goes down, you start wondering, why in the world did I selected that company, right? And if you don't understand why and you don't understand the business model, well, then you're going to feel lost, and then fear is going to go up, and you might eventually just panic sell just because you don't really understand what the business does. So it's one thing to look at numbers because, I mean, everybody can read a graph that is going from down to high, right? It's quite easy. But when you're considering, okay, so what is semiconductors and like how's it used and how come we talk about semiconductor short supply right now? Well, then if you're not able to answer those questions, this means you should not invest in semiconductors because you don't understand the business. And whenever it's going to go up or down, you will not be able to explain it to yourself. So my trick here is if you're not able to explain to a 12-year-old how the business is making money, you're better off selecting another industry.
All right. Okay. So let's take a closer look at two examples. And so when we're looking at these examples, what jumps out to you about their similarities and their differences?
Yeah, so we selected company A and company B. So we're not going to name any companies, but utilities. So they're both doing electric transmission and stuff like that. And the idea is just saying, okay, so we use power, and to get power to your house, to get power to industries or to the stores, you need a company that will be able to either generate that power or transport it through electric lines and give it to customers. So that's how you can define the business model in an easy way. Now you have differences. So on company A, you have a business that is 100% regulated, meaning that this company works with contract. They have monopolies pretty much everywhere where they operate, and they deal with a regulator to say, oh, I need to increase the rates for my customers. So it's not an open market. It's not a free market. They have like regulators that will decide if the demand to increase rate is reasonable or not. So there will be a negotiation play, but it's a lot easier to forecast your future cash flow, especially if you have a history of negotiating with the same regulators over and over. You pretty much know that if you ask for 12%, you're going to get back 10, and this is how it's going to happen. On the other side, the other company has a part of regulated utilities, but also focus on growth by acquisition and as a renewable energy segment. So this business will bring a little bit more growth, but sometimes with renewable energy, you're going to have an open market, meaning that you don't need to deal with regulators, but you're going to have competition on your own turf. So you better manage your utilities in a good way, make sure that they're profitable and that your future project will be able to sell electricity at a competitive price, which when you have regulation everywhere, you don't have to worry about that too much.
All right. So this is a basic way that an investor can just, once again, as you mentioned, look at the business models between, let's say, different companies they have on that list that has popped up, and just have an idea of what the businesses are doing, their similarities and differences. Okay, so let's move on to the third step, and that is to compare the dividend safety and expected dividend growth between the remaining companies that are on the list. So how do you go about this?
Well, once you have used the dividend triangle as a screener, you already have a pretty good idea if the company will be able to increase its dividend in the future. Because if you look at the past and you say, okay, so revenues are increasing, earnings are increasing, and management has this habit of increasing its dividend every single year, you're already in a good position. But then you want to see how that dividend has been growing over the past 5 years, because maybe they just increase it like in 1 year by 25%. And after that, it is slowing down every single year. So that tells you there's something about the business, just like the business is slowing down a little bit. There might be a problem, maybe more competition, or maybe they expect a recession and they stop increasing their dividend by like 8% and they go back down to 3% or 1 cent per share. Now you can start to feel a bit more concerned about the dividend safety. The other thing I'm going to look at, obviously, are payout ratios. So you have the cash payout ratios, you have the classic payout ratios based on earnings, a little bit more digging into metrics, but having a good idea if the payout ratio is over or under 80% will give you a good idea if the dividend is safe or not. It doesn't mean if you find a company with a payout ratio at 100% or 125, it doesn't mean a dividend is not safe. But then it requires you to do more digging to understand the financial behind this high payout ratio and see, is it a one-time event that is completely destroying earnings for 1 quarter or for a year, and next year the payout ratio will fall in line, or is the company is in difficulties? Most of the time, if the dividend keeps increasing and there's a high payout ratio, there's a good explanation. If the dividend doesn't increase and you have a high payout ratio, well, then you're starting to cook a recipe for a dividend cut.
Right. And that's because the dividend payout ratio is a percentage of after-tax earnings that the company is actually using to pay out dividends to its shareholders, right? And so that's why, to your point of if that payout ratio is going up, but you're finding the earnings are not going up, it means that the dividend payout is eating more into how much the company has left over to run its business.
Yeah. So basically, if you have a very high payout ratio or a payout ratio over 100%, it means that you're not making enough profit based on accounting principles. So this is why sometimes there are some explanations. So if you have like a lot of amortization, stuff like that could be more complicated. But in general, 100% payout ratio means that every profit you make, you pay it in dividend. So there's nothing left if you have any unexpected expenses or problems down the road, but to cut the dividend eventually.
Okay, so now that we've talked about these matrix, so tell us, when we're looking at our two examples, what is that information telling us with company A and B?
So for company A, we have something that is very stable, but a little bit less generous than company B that is showing 55% increase over the past 5 years. So right up front, when you look at both, you can see both are stable. So dividend is probably safe. But if you're looking for a company that will increase its dividend a bit more aggressively, it seems that company B probably because of the business model, also with a little bit more growth vectors, with growth by acquisition, with renewable energy, is able to be a little bit more generous with shareholders. If you're moving to the payout ratio, and this is where it gets very interesting because you have like completely two scenarios. You have company A with a payout ratio, which is the classic way to calculate it, of 53%, which tells you completely safe, boring stock, regulated utility, but will continue to increase its dividend in the same strategy always. The cash payout ratio, though, is negative. And then it should flag an investigation here, and you would realize that for utilities, what happened is if you look at the cash payout ratio, you're not going to count new financing, so new debt. So you will have the free cash flow that you generate, and then you will also deduct the capital expenditure, so the money you spend for new projects. Utilities are capital intensive businesses, so it's normal that they spend a lot more than they're making because they are getting more debts also to finance those projects. And if you finance a project at 5%, but you're going to charge 10% rate increase on that project every year and generate more than 10%, in profit, it totally makes sense to use leverage. But if you don't know, again, if you don't know the industry and how it works, a negative payout ratio will scare you off. Same thing for company B when you look at the ratios, which are completely through the roof with 177% and a negative cash payout ratio, but a company that is incredibly generous, able to increase their dividend by 55% over the past 5 years, well, then you need to dig into the financial to understand what's happening there. And then you're going to find some reason, because obviously no management would be irresponsible to just lose money, finance the dividend by getting more debt, and eventually they will go bankrupt. So there must be some explanation, but this analysis will tell you company A, a lot more stable. Company B, there are explanation, but maybe at one point they will run into some hurdles and it may affect the dividend growth policy.
All right. Okay. So now I want us to take another pause so I can show our audience how they can track some of the metrics that Mike mentioned for assessing dividend safety and growth in WebBroker.
In WebBroker, click Research and Stocks. Enter in the name of a specific stock. And then click on Fundamentals. Once here, click on Peer Comparison. Scroll down to the Dividend section. Once here, you're able to see the dividend rate, the dividend yield, as well as the dividend payout ratio for that specific company, what the industry average is, as well as key peer companies. To see additional information, such as historical dividend payouts and changes to the annual dividend rate, click on Events and Dividends. Once here, an investor is also able to calculate the annual dividend growth based on these figures.
All right. So, Mike, let's touch on your fourth point, which is to identify potential sources of growth for the company. We've talked extensively about growth. So, what are some of the growth vectors you like to see?
When I analyze companies, I want to see if the business is investing in research and development and innovation, because I want to make sure that their product or services is always at the top edge. Some will grow by acquisition, which is a great way to increase, but you still want to see some organic growth, because growing by acquisition can last only for so long. At one point, you may become too big and there's no more good acquisition that will move the needle in your financials. You can have in utilities, we're going to see if the company is able to increase their rates, if they are active in states or provinces with a growing demographic, because more people means more demand for power, obviously more revenue for utilities. So those are the growth vectors you can find in the utility world.
All right. So let's move on to step number 5 now, which is the process to understanding the potential risks for the company's business. And what are some of the warning signs that you're keeping an eye out for?
Definitely debt, especially now that interest rates are rising. So it was easy to get almost free money when you get such like low interest rate on your debt, and then make your project profitable. Now that it's increasing, well, first your large debt may become a burden, and your future project, especially if you look at utilities, well, they spend a lot of money every year. We're talking about billions. Well, now if your debt are at 6% and they used to be at 3, at one point it may be hard to make it profitable, and your project will not have the value you thought it would because the economy is changing around you. So that is one thing. The other thing is, if you look at renewables, most of them right now, they benefit from subsidies from government. That's the case today. Doesn't mean that in 3 years, government will continue to do those subsidies. And if you lose them and you become less profitable or not profitable at all because you rely on money coming from outside of your business, then it could become a problem. So for the utilities, it's really about that, because besides that, I mean, people need power. That is still a very stable sector. Even if we enter a recession, revenue are slightly going to go down, but not by that much, because I mean, at night you still need to heat your house and then to cook for dinner, watch TV, whatever. So you'll need that power anyway.
Okay, so now that we've talked about the growth drivers and some of the risk factors, how would you size up our two examples in this case?
Well, for this one, for company A, we have a large capex, strong demographic, and rate increase because they deal with regulators. So for the growth, it will be not that impressive, but pretty stable. In terms of risk, then obviously lack of growth is one of the main concern, because once you're established somewhere, you only hope that there will be more people come into the cities, more people come into the states. So at this point, maybe not that interesting going forward. And the interest rate will definitely be a burden, as I mentioned earlier. For company B, you have more growth vectors, but you also have more risk. So for growth vectors, obviously, renewable energy, super trendy right now. So this is something that we have like always. We also have money to fund those projects right now. Grow by acquisition is always great. And then you have similar growth perspective with demographic and rate increase. For the risk though, this business needs more financing because they have more growth vectors. So they will get more debts. They will also issue more shares. So the more shares you issue, the more you dilute the value for shareholders, unless you make the right acquisition that are more profitable and they bring more money to the table. If it's not the case, you're actually destroying value. So you have to be careful. So you can see that company A has a little bit less growth vectors, but less risk. Company B has more, but from both categories.
All right, so that's a great summary. And that actually ties into our sixth and final point, because you talked about value and valuation of the company. And the sixth point is, how to compare the valuations of the remaining stocks that you have on the list. So now they may be many approaches to valuing a company, and which ones do you prefer?
First, I must say I'm not a big fan of using valuation models. The reason being is you can select 10 CFAs, put them in a room, and ask them to calculate the valuation for company A and company B, and you're going to have dozens of different answers. And most of it are just guesses because you're taking assumptions for the future, and just you're hoping that cash flow will grow that much, or debt will be at this level, or like this capex will result into projects that will be at that type of valuation. So it's a lot of guessing, but it's very useful when you use the same methodology to compare two companies. So one that I really like is to use the dividend discount model because it's going to give you a value based on future dividend expected. So you look at all the future dividend payments, you discount them, and you bring their value as of today's date. But if you look similar numbers for two companies in the same sector, you're going to find the one that is trading maybe at a premium or at a discount. So it's going to help you identify the one that has the best value. Another trick that I really like to watch is the trend for the price earning ratio and also for the dividend yield. In general, the market will give pretty much the same valuation to a stock throughout time. So for the past 5 or 10 years, if you look at the PE trend, the PE ratio trend, same thing for the dividend yield, unless there's a major event affecting the business, it will be usually about the same thing. So if one company has a very high yield at one point and used to have like something around 2-3%, and then boom, explodes to 6, it tells you that it may be an opportunity because definitely the stock price has gone down, or there are some warnings here because the market doesn't think the business can replicate past growth. So it's a great indicator as well to make a choice between one or the two companies if you're looking for something a little bit safer, or if you're looking for opportunities but you're willing to take more risk. You will be able to make that difference using those graphs and looking at the dividend discount model.
Okay, so what does each valuation method suggest to you about our two companies?
As you can see, for the price earning ratio, we have something a little bit more stable for company A, which is not a surprise. And as you go down to those steps, you should realize you should have a pretty good idea of which kind of company you want and one versus the other. Nobody will be surprised to see that company B is a little bit more hectic, trading right now as a higher PE ratio. Chances are it's either because the stock went down or because the company has lower earnings, or the business saying, oh, you know what? We are willing to pay a higher valuation. So it gives you an idea of like the fluctuation. And when you look at the yield, you're going to see that company B is increasing in yield now at almost 5%. It's close to its higher point in the past 10 years, telling you that there's either a problem or concern around the market, or it is definitely a very good deal if the business is able to replicate the growth they have offered in the past 10 years. For company A, a little bit more stable here, and again, lower yield. So telling you that borrowing is very effective when you don't want to mind about anything. There's some more stability. So there's a big difference here. And again, probably not as good as an opportunity in terms of capital appreciation if you select company A over company B. But again, probably less risk as well.
Now I want to jump into WebBroker one last time to show our audience how they can track changes to some of the valuation matrix.
In WebBroker, click Research and Stocks. Type in the name of a stock and then click on Charts. Once here, click on Lower Indicators and select PE ratio. Also select Dividend Yield. Change your time frame to 5 years. And now you're able to see the changes in the PE ratio as well as dividend yield for that specific security over time, giving you an idea of how much fluctuation has happened in each metric over that time frame.
Okay, so before we get to our final verdict, I do want to go over a quick summary of the 6 steps that we've talked about today, Mike. So we mentioned step 1 would be screening using the dividend triangle. The second step would be to narrow down the list of companies using a simple business model. The third is to compare the dividend safety and expected dividend growth between the remaining companies that we have on our list. The fourth would be to identify the potential sources of growth for the company or companies that we're looking at. The fifth would be to understand the potential risks of the company's business. And the sixth would be to compare valuations of the remaining stocks on the list. So that brings us to the final verdict. What other considerations do you have that might help you decide which stock may be best for your portfolio?
That's a summary of what we have discussed today. But with those 6 factors, it's now very easy to see if you want company A for its stability and its lack of growth, but less worry, or if you want company B that will likely has more up potential, but could give you some headaches, has a little bit more risk. So if things doesn't turn out the way you want, you're going to have more risk with company B. If you say, okay, I'm an income investor, I'm going to go for A. I'm a growth investor, I'm going to go for B. But in the end, both companies are still very solid. They are still showing a lot of great characteristic because you have used a clear strategy. But by selecting them from the dividend triangle, it's going to be a lot easier to find the best cherries from your basket instead of just looking at the entire sector of utilities where you have very bad businesses struggling with too much debt and not enough income and cutting down their dividend. Well, then you already selected two great companies. But again, it's very easy to make the difference between which type of investors will select A or B.
All right. So thank you so much for taking us through your valuation process, Mike. It's been fascinating and it's been a great conversation. And I'm sure that our audience has plenty of follow-up questions for you. So let's find out what they'd like to hear about in our live question and answer segment. So we'll see you there in just a moment.